What if I told you a company could post the best revenue numbers in its entire history and still lose nearly $500 million in market value within 4 hours? Not 4 days, not 4 weeks, 4 hours. That is exactly what happened to SoundHound AI on May 7th, 2026. And here on Smart Stock Sam, we are pulling back every layer of this story because buried inside this paradox is the question every serious investor needs answered right now. Is SoundHound stock actually undervalued after this 12% crash on record revenue, or is this just the beginning of something far worse? We are talking record-breaking top-line growth, a jaw-dropping margin collapse, a bold acquisition bet, mysterious insider selling, and a short interest so massive it could trigger either a catastrophic collapse or the most explosive short squeeze of the year. Stay locked in. By the end of this video, you will have a complete actionable framework on one of the most fascinating and dangerous trades in AI right now. Now, before we ever open a spreadsheet, we have to stare directly at the carnage on the charts, because this is where the story truly begins. Going into the afternoon of May 7th, the mood around SoundHound was absolutely electric. The stock climbed nearly 3% to close at $9.63, supercharged by a high-profile broker upgrade and a wave of AI enthusiasm sweeping through the market. Investors were leaning in hard, positioning themselves for what they believed would be a moonshot earnings report. The whisper numbers were bullish. The sentiment was euphoric. And then, the moment that report hit the wires, the floor completely fell out from underneath this stock. In after-hours trading, SoundHound collapsed by 12%. Plunging as low as $8.47. By the time pre-market opened the following morning, we were staring at a valuation floor of approximately $8.68. In total, that single earnings release vaporized roughly $444 million in market capitalization. Almost $500 million gone before most investors even had their morning coffee. So what exactly was hiding inside that report that turned a strong buy into a near panic sell overnight? To truly understand this move, you first have to understand that SoundHound is currently telling two completely separate and deeply conflicting stories at the exact same time. Think of it as a tale of two companies living inside one ticker symbol. On one side, you have the Triumph, a growth engine firing on all cylinders, generating revenue at a pace that most established tech companies would genuinely envy, powered by real enterprise momentum in the AI industry. On the other side, you have the drag, a bottom line under severe and accelerating pressure, with operational costs that are beginning to cannibalize those impressive top-line gains at a rate that is making even the most bullish analysts nervous. And there is one hidden metric buried in this report that completely rewrites the risk profile of this stock. We will get there. But first, let us talk about the good news, because honestly, it is actually quite remarkable. SoundHound just delivered a record $44.2 million in Q1 revenue. That is a stunning 52% jump year over year. But here is where it gets even more impressive. If you strip away the noise from recent acquisitions and look purely at their core automotive and IoT artificial intelligence business, that segment surged by 88%. They are not just talking about growth on earnings calls, they are actually executing it in the real world. They locked in a 7-figure global commitment with a major Japanese manufacturer. Their AI-enabled drive-thrus are demonstrably generating higher revenue than traditional locations. And sitting behind all of this, a war chest of $216 million in cash with absolutely zero debt on the balance sheet. On paper, this company looks like a fortress of growth, a clean, well-funded, hyper-growth AI platform scaling into one of the most exciting technology markets on the planet. If that were the whole story, this stock would probably be sitting at $15 right now. But it is not the whole story, not even close. And here is exactly where things get ugly. Here is the gory detail that the market absolutely despised. SoundHound missed the consensus earnings estimate. Wall Street had modeled a loss of 4 to 5 cents per share. SoundHound delivered a loss of 6 cents per share. That is a miss, and in this market environment, misses get punished severely. But the earnings miss was almost secondary to the real problem, the margin squeeze. Their GAAP gross margin did not just dip slightly. It plummeted from 36.5% all the way down to 31.1%. Management is attributing this to what they are calling non-recurring vendor true-up costs, essentially a one-time penalty payment owed to a key supplier. They want you to believe this is a speed bump, a one-time accounting adjustment that inflated costs artificially in this single quarter. But the market is asking a far more uncomfortable question. What if this is not a one-time event? What if this is the early signal of a structural problem? A business model where the cost of sustaining explosive growth is quietly becoming too expensive to maintain at scale. And when you lay both sides of this story on the table simultaneously, the paradox becomes impossible to ignore. Record revenue generation, but it was propped up by costly and painful vendor adjustments. An 88% surge in core organic scalability, but it came at the direct cost of $26.3 million in operating cash burn in a single quarter. A massive and enviable cash runway, but gross margins just contracted by 540 basis points. And all of this happened even as Ladenburg Thalmann issued a strong buy rating right before the earnings bell rang. The EPS miss alone carried enough weight to shatter the momentum completely. Now, to see exactly why the market is so deeply rattled by this, we need to follow the actual path of the money, because the numbers tell a story, the press releases will not. Think of it as a waterfall of worry. It starts beautifully at the top with that record, $44.2 million in revenue. But then, the cost of operations drags the gross margin down to 31%. Then you layer in that vendor true-up penalty. Then you add the enormous research and development outlays and the aggressive expansion costs required just to stay competitive in this brutally fast-moving AI landscape. And what are you left with at the bottom of that waterfall? A $25 million net loss and $26.3 million in operating cash burned through in a single quarter. At that burn rate, that $216 million cash pile does not feel like a fortress. It starts to feel more like a countdown clock, and that clock is ticking louder with every passing quarter. But management is not standing still. They have a bridge they believe will carry this company to a dramatically higher valuation. And it is built on two very bold pillars. The first pillar is an acquisition that many investors are still trying to fully process. In April, SoundHound announced the acquisition of LivePerson in a $43 million all-stock deal. Combine SoundHound's established dominance in voice AI and automotive intelligence with LivePerson's deep expertise in digital messaging and customer engagement. And what you get is what the company is calling an omnichannel conversational platform. The thesis is powerful. If they successfully close this deal in the second half of 2026, management believes it unlocks a $500 million revenue opportunity. It is a genuinely bold, high-conviction bet on becoming the all-in-one conversational AI partner for major global brands. Could this single deal reshape the entire revenue trajectory of this company? It is not impossible, but the execution risk is enormous. The second pillar is purely technological, and this is where SoundHound is trying to build a real competitive moat against the giants of this industry. Meet Oasis, SoundHound's newly launched self-learning agentic AI platform. Here is the problem Oasis is designed to solve. Right now, if a large enterprise wants to build and deploy a custom AI agent for their business operations, that process takes months of development, integration, and testing. Months. Oasis claims to compress that entire timeline from months down to minutes. That is not an incremental improvement. That is a revolutionary change in deployment speed, and this is their secret weapon in the war against NVIDIA and Google. While the technology giants focus on providing the hardware infrastructure and the large language models, SoundHound wants to own and dominate the orchestration layer, the critical middleware that makes artificial intelligence actually function and deliver value inside a real business. If Oasis delivers on its promise, the competitive moat could be extraordinarily deep. So we have record revenue, a major acquisition on the table, and a potentially game-changing technology platform. Then why are the company's own insiders selling their shares? This is where the story takes a genuinely murky turn. On one side, institutional giants are piling in. Vanguard increased their position by 16%, Morgan Stanley by 48%, and UBS by a massive 77%. Smart money is clearly accumulating. But on the other side, the CEO and COO quietly unloaded approximately 177,000 shares in March at an average price of $6.79 per share. Executives sell for many reasons, but it is never a comfortable visual when the captains are offloading personal positions while simultaneously telling the public that hypergrowth is just around the corner. And then there is the 38% short interest. Nearly 4 in every 10 shares are currently being bet against. That is either a flashing warning of deep institutional skepticism or the most perfectly loaded spring for a short squeeze that could rocket this stock to levels that would genuinely shock even the most optimistic bulls. Which one is it? That is the question worth $1 million. And that exact tension between the bulls and the bears is playing out in real time on the technical charts. Before this earnings drop, the technical picture was screaming bullish across every major indicator. The RSI sat at 64, healthy momentum without being dangerously overbought. The MACD was positive and trending upward. The stock traded comfortably above its 5-day, 50-day, and 200-day moving averages simultaneously. Everything looked constructive. But the after-hours move did something technically catastrophic. It shattered the $9 support level on significant volume. When you break a key technical floor in a single session, the previous uptrend is not just paused, it is officially dead. A new base must be built from scratch. And the urgent question for every investor watching this stock is, where is the new bottom? For that answer, we turn to where the real money puts its chips, the options market. Going into the earnings report, sophisticated options traders were pricing in an implied move of approximately 15.9% in either direction. There was a clear bullish bias embedded in the positioning, with heavy open interest concentrated at the $9.50 and $10 call strikes. But this 12% plunge has driven the stock directly into the absolute bottom of that implied volatility range. If the stock cannot find genuine buying support and stabilize at this level, technical analysis points clearly toward the next meaningful floor, approximately $7.80. That is the true line in the sand. Below that level, the conversation changes entirely. Now, none of these data points matter in isolation. What matters is how you weigh them together. Long-term vision against short-term risks. The bull case is genuinely compelling. 52% revenue growth validates the core technology. The LivePerson acquisition could create a dominant omnichannel AI player. And Oasis, if it delivers, builds a moat even the largest technology companies would struggle to replicate quickly. But the bear case is equally loud. 38% short interest signals deep institutional skepticism. Margin contraction raises the uncomfortable possibility that SoundHound is buying its own growth through unsustainable cost structures, and that consistent quarterly cash burn is a genuine ticking time bomb against that $216 million runway. Before we wrap up, a quick but important financial disclaimer. Everything discussed in this video is strictly for educational and informational purposes only. Nothing here constitutes personalized financial advice, investment recommendations, or a solicitation to buy or sell any security. Always conduct your own thorough due diligence and consult a qualified financial professional before making any investment decisions. Markets are unpredictable, and all investing involves risk, including the potential loss of principal. So how do you actually play this? Here is your actionable framework. In the near term, the next 30 days, the single most critical number to watch is the $7.80 to $8 support zone. If that level holds on meaningful volume, this earnings sell-off may simply be a classic institutional shakeout before the next leg higher. If it breaks convincingly, the risk profile shifts dramatically. You also need to listen carefully to management's language around those vendor true-up costs. If that phrase appears again next quarter, the non-recurring excuse is officially dead, and margin compression becomes a structural problem, not a one-time event. For the long-term picture, everything comes down to the $1.2 billion revenue backlog. That backlog is the foundation of every optimistic growth projection this management team has made. If they cannot convert it into recognized revenue at an accelerating pace, the 2027 target of $350 to $400 million remains exactly what the skeptics say it is, a beautiful projection with no credible path to execution. SoundHound AI is a classic show-me story. The growth is real, the technology is differentiated, but the profitability clock is ticking, insiders are hedging, and short sellers are circling. This is not a stock for the faint of heart, but for the patient, informed investor, it may be one of the most asymmetric setups in the entire AI sector right now. Now, here is the question I want you to answer in the comments below. Given everything we just covered, the record revenue, the margin collapse, the insider selling, and that massive 38% short interest, do you believe SoundHound is a deeply undervalued AI gem hiding in plain sight? Or is this a value trap dressed up in impressive growth numbers? Drop your honest take below. I read every single comment. If this breakdown gave you real clarity, please hit that like button right now. It takes 2 seconds and helps this channel reach more investors who need this depth of analysis. If you are not yet subscribed to Smart Stock Sam, subscribe now and ring that notification bell so you never miss a deep dive like this one. And if you want to support the work we do here, you can send a super thanks using YouTube's support feature right below this video. Every contribution means the world and keeps this channel going strong. Thank you for watching, stay sharp, stay curious, and I will see you in the next one.